This is Economics, Chapter 25. So in this chapter, we're going to talk about money, banks, and the Federal Reserve System. So one of the examples from the book talks about Coca-Cola dries up as money floods Zimbabwe. In 2008, Zimbabwe ran out of the locally produced Coke for the first time in at least 40 years. Real GDP fell more than 12%. So African countries were suffering many shortages of basic food goods from epic inflation rate of epic proportions, which is called hyperinflation. As the value of its currency fell against others, by the end of the year the exchange rate was $1 to 2 billion Zimbabwean dollars. The faster its government printed more money to pay for all of its expenses, the faster prices rose, eventually plunging the country's economy into a devastating recession. In 2009, a new government took drastic steps in abandoning its own currency and making the US dollar its official currency. We'll talk about how this happens and what happened to both businesses and consumers in the recovery from the recession. So, what if money became increasingly valuable? Most people are used to the fact that prices rise every year and purchasing power of money falls. You will be able to buy fewer goods and services with $1,000 a year from now than you would be today, and you'll be able to buy even fewer goods and services the year after that. This is due to inflation. In fact, with an inflation rate of just 3%, 25 years from now, $1,000 will buy only $475 can buy today. At the end of this chapter, see if you can answer this question. What would be the advantages and disadvantages of living in an economy where purchasing power of money rose each year? Alright, what is money and why do we need it? Defining the four functions of money. Money is an asset that people are generally willing to accept for exchange for goods and services to pay debt. An asset is anything a person owns of value. When we talk about barter and the invention of money, economies where goods and services are traded directly for each other is what we call a barter economy. We see this happen when the recession started to happen in 2007-8. We saw people go to trading. I'll fix your car, you dye my hair, more so than before the recession because people potentially lost their jobs and they're now trying to trade their skill with someone else's skill to get the goods and services that they need. For barter to take place between two people, each person must want what the other has, a requirement economists refer to as double coincidence of wants. Now, then we have such thing as commodity money. It's a good that can be used. A good uses money that also has an independent value. By making exchange easier, money allows people to specialize and become more productive when pursuing their comparative advantage. Now, if you fix cars and I dye hair, but you don't want your hair dyed, how do I get my car fixed? In a barter society. So the four functions of money. Anything used as money should fulfill the following four functions. There must be a medium of exchange, a unit of account, the money must be able to store value, and there must be a standard of deferred payment. Well, what does that all mean? A medium of exchange is money that serves as a medium when the sellers are willing to accept it in exchange for goods or services. An economy is more efficient when a single good is recognized as a medium of exchange. So for us, that's the US dollar. In other countries, it's their dollar. But if you are in jail, for instance, you don't have access to money, you might be using something like cigarettes as a medium of exchange. So, a unit of account. Once a single good is used as money, the dollar, each good has a single price rather than many prices in a barter system. You know, if you go back to the days where people were trading sheepskin for something else, it's hard to know how much value sheepskin has because to a person who has a bunch of sheep, not a lot of value. To a person who doesn't have any, lots of value. So, that's why it's easier to have something like the US dollar. It must store value. Any asset represents a store of value. Liquidity is the ease at which the asset can be converted into the medium of exchange. When we talk about this in finance, we talk about liquidity ratios. How quickly can that be converted to cash? Although money is the most liquid asset, other assets offer a greater return as a store of value. Standard of deferred payment. Money can facilitate an exchange at a given point in time by providing a medium of exchange and a unit of account. It can facilitate exchange over time by providing a reliable store of value and a standard deferred payment in order for borrowing and lending to happen. This is necessary to make our banking system work. What can serve as money? 5 criteria make something suitable. The good must be acceptable to, that is usable by most people. The good must be standardized quality so that any two units are identical. It should be durable so that the value is not lost by spoilage. We don't want to use something like fruit because it goes bad. We can't store value for 10 years. That fruit is not going to last for 10 years. It should be valuable relative to its weight so that the amount's large enough to be useful to be traded easily. So if we're trading giant boulders, well, that's not really easy, and I can't really train that. Something that's come up fairly recently that's been pretty popular that there's a whole bunch of debates about is called Bitcoin. This is online currency. So there's questions about, is this a good investment? Is it money? Is it going to be acceptable, quote unquote, to most people? So the medium of exchange should be divisible, because different goods have different values. Dollar bills meet all of these criteria. Commodity money is independent of its use and has value. Money such as gold depends on its purity. We used to have the US dollar tied to gold, but now the US dollar in modern economy is paper currency is generally issued by a central bank, which is an agency of the government that regulates the money supply. This is called fiat money. The US dollar is called fiat money. The Federal Reserve is the United States central bank. Fiat money, such as paper currency, is authorized by the central bank or a government body and does not have to be exchanged by the central bank for something like gold. It used to be in order to print the dollars or to have dollars, we had to have gold backing it. So it had to be exchanged for gold. But that's not the case. The US dollar bill is actually a Federal Reserve note issued by the Federal Reserve. The Federal Reserve currency is a legal tender in the United States, which means the federal government requires that it be accepted in payment of debts and requires that cash or check denominations in dollars used to be paid taxes. Households and firms have confidence that if they accept paper dollars in exchange for goods or services, the dollars will not lose much value during the time that they hold them. This is the whole idea. If I can't store it, can it be money? A woman in California went to Apple and tried to buy an iPad using $600 in currency. Having just released a new product, Apple did not want to sell large quantities to people who were reselling them, so the company required customers to pay with either a credit or debit card to make it easier for them to keep track of anyone trying to buy more than the two-person limit. Although the Federal Reserve's notes are legal tender, the law does not require firms to accept paper money from customers as payment for goods or services. Still, in response to the bad publicity over the event, Apple lifted its ban on cash payments and presented a free iPad to customers whose cash had originally been denied. The definition of money supply in the United States. So we're actually not going to talk about the definition of money supply in the United States. So I'm just going to click through here. We're going to move on to 25-3, which is to explain how banks create money. So a bank creates money by actually giving out loans. If you look here, loans are an asset to a bank. Now, it's a debt for you and I personally if we take out a loan, but to a bank, it's an asset. This is how banks make money. So there's what a bank has reserves. This is deposits that the bank keeps as cash in its vault or on deposit with the Federal Reserve. Reserves are not loaned out or invested. Vault cash is actually physically kept within the bank. That's a much smaller amount. And then we have reserves, which are kept either in the bank or with the Federal Reserve. So reserve requirements are the amount the bank is legally required to hold based on its checking account deposits. This is a percentage. We have a fractional banking system in the United States. You do not have to hold 100% of all deposits. Otherwise, the banks could never loan out money. Then we have a required ratio. This is the minimum fraction of deposit banks are required to keep by law as reserve. We can distribute a required reserve ratio. We can abbreviate this as RR. Excess reserves. This is the amount the bank holds above and beyond the legal requirement. Banks make consumer loans to households and commercial loans to businesses. A loan is an asset to a bank because it represents a promise by the person who taking it out to make specific payments to the bank. Deposits, including checking accounts, savings, and CDs, are liabilities to the bank because they owe this to the household or firm who deposited the money. They're just holding it. I'm not worried about T accounts of creating money. We're going to skip this part. Now we're talking about the general overview of the Federal Reserve System. The Federal Reserve has three policy tools it uses to manage money. First of all, remember, we have a fractional banking system. What that means is a banking system which requires banks to keep less than 100% of reserves on deposit. A bank run is a situation in which many depositors simultaneously withdraw money from one bank. So if there was a bank run at Bank of America, we would all go and take out our money from Bank of America, but that's just because we felt Bank of America was failing. Now, banking panic is a situation where many banks experience bank runs at the same time. This is a situation where there would be potentially financial collapse of the entire banking system. So there were bank runs in 1913, and this is when the Federal Reserve was created and the central bank. And the whole purpose of the Federal Reserve when it was created was to stop bank panic, which means they wanted to stop all kinds of people taking out their money at the same time from various banks. So the Federal Reserve was acting as a lender of last resort. In acting as a lender of last resort, the central banks makes loans to banks when they can't borrow funds from anywhere else. So the central banking system was set up to prevent banking panic and loan money to banks. With the intention of putting an end to banking panics and their accompanying recession, Congress passed the Federal Reserve Act of 1913, setting up the Federal Reserve, also known as the Fed. Discount loans. This is the loan that the Fed makes to the bank. So you and I don't go to the Fed and borrow money. Our banks go to the Fed and borrow money, and the rate that they pay is a discount rate. This is the amount of interest that the Federal Reserve charges the bank. In response to bank failures that were occurring at the onset of the Great Depression, Congress established the FDIC. Usually when you go to the bank, there's a little gold card that says, this is FDIC insured. And this was created in 1934 to insure deposits at most banks up to a limit, which is currently $250,000 per deposit. So this is to create security in the banking system. So you know if you deposited in a specific bank and they are insured by the FDIC, that up to $250,000 of your deposit is insured. Here's the setup of the Federal Reserve. There is a board of governors overseeing the Federal Reserve System. There are 7 members who are appointed by the president and serve a 14-year non-renewable term. 1 member is appointed as the chair and serves a 4-year renewable term. So there are 12 Federal Reserve districts, each of which has a bank. We have Boston, New York, Philadelphia, Washington, D.C., Richmond, Atlanta, Cleveland, Chicago, Minneapolis, St. Louis, Kansas City, Dallas, and San Francisco. Obviously, it's heavily concentrated in central and eastern United States. The real power within the Federal Reserve, however, lies in Washington, D.C. with its Board of Governors. This consists of seven members appointed by the President, and monetary policy is carried out by the 14-member Federal Open Market Committee, or FOMC. It is responsible for managing the money supply and monetary policy. So what is monetary policy? Monetary policy is the action taken by the Federal Reserve to manage the money supply and interest rates to pursue macroeconomic policy objectives. To manage money supply, the Fed has three tools: open market operations, discount policy, and reserve requirements. All three of these tools are aimed at affecting the reserve of banks as a means of changing the volume of account deposits. So the open market operations, this is the buying and selling of treasury securities by the Federal Reserve in order to control money supply. FOMC, or the Federal Reserve Committee, is responsible for open market operations and managing the money supply in the United States. Remember, the maturity of a financial asset is the period of time it takes a purchaser to receive payment of the face value or principal. To increase money supply, the FOMC directs the trading desk located at the Federal Reserve in New York to buy U.S. Treasuries. So if you want to increase money supply, they buy U.S. Treasuries. Sorry, click that. And if the Fed wants to decrease money supply, they sell U.S. Treasuries. So people in the open market buy the treasuries, they take the people's cash, therefore reducing the amount of cash on the marketplace. By initiating open market operations, the Fed completely controls the volume, thus can make both large and small and implement them quickly without administrative delay or required changes in regulation. Another way the Fed controls the money supply is by discount policy. If they lower the discount rate or the amount charged to banks, then the banks can charge consumers and businesses, firms and households, less money, which means it will increase checking account deposits and the money supply. Raising the discount rate will have the reverse effect. Reserve requirements. This is a reserve ratio. This is how many deposits they must keep on hand. The more money the bank can lend out, the more opportunity the bank has to make money, the more money in supply in the marketplace. If the Fed raises the reserve requirement, it actually lowers the money supply in the marketplace. So, the shadow banking system of the financial crisis. The banks we have been discussing in this chapter are called commercial banks. Most important economic role is to accept funds from depositors and lend it to borrowers. In the past 20 years, two important developments have happened in the financial system. Banks have begun to resell their loans rather than keep them until they're paid off. Financial firms, other than commercial banks, have become sources of credit to businesses, therefore creating what we would refer to as the shadow banking system. Securitization. Securitization comes to banking. Traditionally, when a bank made a residential mortgage loan to a household or commercial loan to a business, the bank would keep the loan, collect the payments until the loan was paid off, and makes interest on each payment. Now, a security is a financial asset such as a stock or bond that can be bought and sold on a financial market. When a financial asset is first sold, it takes place in the primary market, when all subsequent sales take place in the secondary market. Prior to 1970, most loans were not securities because they could not be resold. There was no secondary market for them. But then there were a growing number of loans that began to be securitized. It's the process of transforming a loan into a financial asset. So all these mortgage-backed securities that you heard about in the news, this is what we're talking about, where we took a loan and we had securitization and we created a security with the loan. So the process. 1. A bank grants a loan to a household. So we grant the loan to the household. 2. The loans are bundled into securities. Once they're bundled into securities, investors purchase the new securities. The flow of payments. So if this securitization happens, what the household pays the bank the loan payment. The bank collects a fee for processing it and then sends the money on to the investors. So when all of these mortgages were packaged up and sold as securities, when the household started defaulting, the bank wasn't collecting their fees and they definitely weren't passing it on to the investor because they weren't getting their money. Investment banks differ from commercial banks because they don't accept deposits. They rarely lend directly to households, and they have traditionally concentrated on providing advice to firms issuing stocks and bonds or considering mergers. In the late 1990s, investment banks expanded their buying of mortgages by bundling large numbers of them together as bonds, or known as mortgage-backed securities, often having higher interest rates than other securities and comparable default risk, and reselling them to investors. Money market mutual funds sell shares to investors and use the money to buy short-term securities such as treasury bills and commercial paper issued by corporations. Then we have another group. We have the hedge fund. They raise money from wealthy investors and use sophisticated investment strategies that often involve significant risk. By raising money from individual investors and providing it directly or indirectly to firms and households, these firms are referred to as the shadow banking system. They are carrying out a function that was one time almost exclusively for commercial banks. So what happened in the financial crisis of 2007 to 2009? The firms in the shadow banking system differed from commercial banks in two important ways. The government agencies that regulate commercial banking system, including the Fed, do not regulate these investment firms. The firms were more leveraged or heavily in debt than commercial banks were. That is, they relied more on borrowed money to finance their operations and increase the potential for larger profits, but also larger losses. The more leveraged a company is, the more risky it is. Beginning in 2007, firms in the shadow banking system were quite vulnerable to runs as housing prices fell and borrowers defaulted on their mortgages. As an underlying cause of the mortgage crisis, problems in the U.S. housing market led to a myriad of troubles in our financial system. 1. Mortgage-backed securities lost value, and their investors suffered heavy losses. 2. Many investment banks and other financial firms without deposit insurance that had borrowed short-term and invested it in long-term had to sell their holdings in the security at a loss of value. In 2008, the failure of investment bank Lehman Brothers set off a panic, and the process of securitization nearly grinded to a halt. So Lehman Brothers went bankrupt. You'll watch this in another video. As a wave of withdrawals from money market funds disabled their roles as buyers of the corporate commercial paper. And then banks and other financial firms sold assets, cut back on lending to shore up their financial position. The flow of funds from savers to borrowers was disrupted, resulting in a credit crunch, significantly worsened by the recession. How did the Fed respond to this? The Federal Reserve response was under TARP, or Troubled Asset Relief Program. This is the stimulus package that we talked about in 2008. The Fed and the U.S. Treasury began attempting to stabilize commercial banking by providing funds in exchange for stock. This is our first step towards a centrally planned economy. The government is taking a role in buying private businesses, so they are providing funds in exchange for stock. The Fed also modified its discount policy, allowing by setting up several new lending facilities enabling it to grant discount loans to financial firms that were previously ineligible. Previously, the financial firm had to go to the bank to get the money. Now the Fed was lending directly. In addition to this, they addressed problems in the commercial paper market by buying commercial paper for the first time since 1930. Also, although these actions of the Treasury and Fed appeared to have stabilized the financial system, the recession continued into 2009, and by late 2011, the flow of funds from savers to borrowers still had not returned to normal levels. We are not actually going to talk about this, so I'm just going to scroll through here and see if there's anything else that we need to answer. And that is it. So this is the overview for chapter 25.